Hey guys, Nikki here. I wanted to talk a little bit about investing today and how I got started in it, which was actually back in March of 2020. Yes, March of 2020. And that was on purpose because I saw the whole world crashing down and I had read for years that millionaires are made during recessions. So I wanted to start investing money then so that I could reap the returns later. I'm so glad that I started investing, but I've gone through so many iterations of strategies, even in just the last 2.5 years. And I wanted to tell you about them so you can avoid some of my mistakes, but also so that you can learn the same things that I learned along the way. And hopefully it creates some shortcuts for you. Also, I'm just gonna put it out there, guys, before I start any of this. I am not a financial advisor, nor am I a financial professional in any way. This is just based on my own experience with investing, both the good things and the bad things, and also just the overall research that I've done. So one of the first things that I bought was something called Tbex. And I just want to say out the gate, I do not recommend this. It's actually, I don't even think it's listed anymore as anything that you can buy, but it's a triple leveraged version of VIX, which is the volatility index that basically measures the fear in the market. So if you can imagine in 2020, that thing was absolutely skyrocketing. Now, I bought this at the recommendation of a friend who does a lot more research on stocks and stuff than I do. And I did make a couple $100s on it. I think I about doubled my investment, which at the time I only put a couple $100s into it. Thank goodness. I mean, yes, I would have made more money if I had invested more, but it was a stupid decision. Don't buy volatility indexes or anything that is that volatile unless you really know what you're doing. And I had no idea what I was doing. I wouldn't recommend it to anybody. The second thing that I began investing in was individual stocks. Now, I've always read that you shouldn't invest in things that you don't understand. And so I started looking at what was going on in 2020 and saying, what do I know the most about? And also, what am I confident will come back after the world stops crashing? So at the time, I was working for one of the major US airlines, and I was really confident in not only their operations, but in the industry as a whole that it would come back. So I actually bought pretty heavily into a bunch of different airlines as well as some hotels. So these stocks ended up having a pretty good return after I bought them. I want to say around like a year or year and a half in, I was seeing a decent return, but honestly not as high as I was expecting. But then of course, as 2022 happened and the world is starting to go back into another possible recession, those stocks have dropped again. One thing I've learned is that betting on a single company coming back from a bad year is a lot more difficult for me to personally swallow than will I think the market come back in general. Because I am confident that the market in general is going to come back in the long run. It just may look different than what it does today. So this is where I really started getting smarter. And that is thinking more long-term and building more diversification into my portfolio. Because if you start thinking about what it's going to take to survive a more extended downturn of the market, you need to have companies that you know are going to make it and know that are going to do well. But you may not always know which ones those are. And there could be larger companies that do really poorly all of a sudden. So as an example, everything that's going on with Twitter, no one really knows if Twitter is going to survive that long term with all of the volatility that Elon Musk has created. Now, it may continue to do well, but it really might end up being that a lot of the other tech companies do really well long term, but Twitter kind of dies out just like Vine did in the past. So you really don't know what's going to happen. That's why owning a group of stocks is a safer bet. And that's where I've gotten into mutual funds. So mutual funds, let me think about how to explain this. So mutual funds allow you to own small pieces of a lot of different stocks rather than bigger pieces of like an individual stock. So let's just take an example here. Let's pretend you're going to the grocery store for a month's worth of groceries and you have, I don't know, $500 to spend. Would you rather have a shopping cart with only bananas and chicken and cheese? Or would you rather have a cart full of a lot of different things that give you options to make a lot more recipes? And think about it this way too, that more diversified cart probably has fresh foods, frozen foods, dried foods, a lot of different things. Whereas, your smaller shopping cart of bananas, chicken, and cheese, they may expire at different times. They may be kept in different places in your kitchen, but there's a lot less diversity. You might get sick of them. Stuff might go bad. It doesn't have as much longevity as the more diversified grocery cart of $500 worth of stuff. And that's what a mutual fund or an index fund gives you. It gives you that built-in diversification. Now, talking specifically about mutual funds for a second, I want to tell you about the two that I bought and why. Not saying that I recommend these, but this was just my logic behind buying them. So thinking back to where I was at when I first found these, it was 2020 and manufacturing of a lot of things was difficult. So specifically car manufacturing, I know, was kind of a nightmare. And this was around when hi there. Hi, buddy. So this was around when I switched to working for the automotive industry again. And so I was seeing all of the issues that car manufacturers were having. And a huge part of why was that no one had semiconductors. There's a massive semiconductor shortage. It's contributing to the microchip shortage, which is contributing to the car shortage. So I saw a fund through Fidelity called FSELX, and it's focused on companies that work in the semiconductor space. So I've invested a lot of money in there. And then I've also invested in PRMTX, which is a technology and communications fund. If you think about 2020, when the world was shifting to online work, things like video conferencing software, phones, computers, all of that good stuff, those companies were doing really well, even though their stock price was technically down. And so I thought that would be a great investment. So both of those have done really well for me until very recently when the market tanked. They're all down again, which, is a huge bummer, but I do think that they'll do well long term. Now, an important distinction with mutual funds in comparison to index funds is that mutual funds seek to outperform the market, and you're going to pay fees because of that. They're actively managed and they're going to be moving things around to try to beat the market. Index funds are passively managed. Typically, there's a set criteria that they'll adhere to, and then as stocks meet that criteria, they'll come in or out of the fund. So an example is a fund that would focus on the S&P 500. If you're not familiar with the S&P 500, it's a group of 500 large companies that are traded on the New York Stock Exchange. It tends to be a really good barometer of where the market is at in general, and companies will kind of go in and out of the S&P 500 depending on how they're doing. This is where you'll see major companies like Coca-Cola or Amazon or Microsoft, like big name companies that you've probably heard of. Now, historically, index funds tend to outperform a lot of mutual funds. Don't get me wrong, there are mutual funds that will make you a ton of money, but a good, safer bet for a lot of people is index funds. This is where I've switched my strategy a bit in the last year or so to focus a bit more on index fund investing instead of the mutual fund investing. I typically buy ETFs, which are kind of an equivalent of an index fund. The biggest difference is that an ETF is something that you can trade during the day, whereas index funds you have to buy at like the close of business. The other thing that I've found with index funds, there is often a buy-in minimum, like $3,000, whereas with an ETF, you can generally just go ahead and buy an individual share, or in the case of Robinhood specifically, a portion of a share, which is nice. The fund that I've been pouring money into in the last year is VOO, and that is the Vanguard ETF that tracks the S&P 500. It has a really good long-term rate of return. I think over the last 3 years, it's over 8%. If you go out 10 years, it's closer to 12%. I'm okay with the short-term fluctuations where it might be down 1 year and massively up another year for that steady long-term rate of return. That's just what I'm most comfortable with as an investor, because I know that I am not going to do probably the right amount of research to find some sort of hidden gem that's gonna make me a ton of money. And realistically, I think that's how most of us are. That's why that more boring route of buying an index fund is probably the right way to go for many people. There's also a ton of YouTubers that will go way more in depth than what I'm doing about their investing strategy and why something like this works well. One channel I think does a really good job of it is Our Rich Journey, and I'll link them up in a card above so you can check them out if you're interested. But as an example, with that 10-year rate of return, VUS is actually 12.63. That means every year you're gaining 12.63% on your money on average per year. Now, I'm just gonna show you a quick calculation I did. If you had invested $100 10 years ago and literally just let it sit, never touched it, and it did see that average rate of return, you would have $328 right now. Like, that's massive. That's the power of time, and that's the power of that growth. And that's why you should be investing for the long term and investing what you can and throwing in that money no matter what's going on with the market, because you're going to kind of average in with the market fluctuations, but in the long term, you should make money in something that is safer, like one of these total market funds or an S&P 500 fund. The latest thing that I've added to my portfolio is dividend investing. So if you're not familiar with dividends, here's the best way I can explain it. So when companies make money, they have a choice of what to do with that profit. They can invest more of it into their own business and grow the business, grow their employees, etc. But some will actually opt to take some of that money that they've made and give it back to the shareholders that are investing in them. And that money that they're giving back is called a dividend. So based on my own research, it's kind of a mixed bag on if people recommend like a dividend focused portfolio. There are some high growth companies that don't pay dividends. So Amazon is a huge example. Now, I think it would be silly to not have a portfolio that includes Amazon somewhere in your investments, even if it's just in a mutual fund or an index fund. So I personally wouldn't go all in on only dividends for that reason. I think you're gonna miss out on a lot of growth. But one thing that I really like about the idea of dividend investing is that if I can grow my portfolio to be, millions of dollars at some point, then the money that I make on dividends, which today I reinvest in whatever fund or stock is making me the money, I would love to be able to just turn off that reinvestment and live on the dividends, which would be a steady income stream, regardless of how the market is doing. It really would kind of insulate you from some of the market ups and downs. That's really appealing to me personally, and that's why I've started adding more into my portfolio. Specifically, the ways that I'm doing this are by investing in a fund called SCHD. It's an ETF that focuses on high dividend yield companies. And I've also chosen to invest a little bit more heavily into two individual stocks. One has the ticker symbol O, and that's Reality Income Corporation. And then the other is BMO, which is Bank of Montreal. Those have traditionally had good rates of return as well as a solid dividend history. Now, again, I'm not switching my focus to dividends. I'm still pouring a ton of money into VU, some money into those mutual funds that I mentioned earlier. I'm just slowly making my way towards a more diversified portfolio. Now, I'm gonna have to shake all of this up when I sell a bunch of investments soon to buy this house that we're planning to purchase. I'm actually trying to evaluate which stocks and funds it makes sense to sell for that down payment. That's another story for another day. Let me know if you'd like to see a video on that, because I haven't seen a lot of guidance online of trying to figure out what to sell and what to keep. So I personally know I have a ton to learn in this space. Please drop some comments if you have any insights of things that you think might help me or someone else. But I hope this helped you on your financial journey, figure out, where to go next in your investing journey. I will say, I just think that everyone should invest at least a little bit of money, especially in some of these more long-term, safe index funds, because it really is how you build wealth. And I wish I had done it 10 years ago, but I can't turn back the time now. I can just only invest in things that I think future Nikki will appreciate. I hope you have a great rest of your day. Thanks for watching.